Good morning, everyone. Welcome, welcome, welcome. Excited to have you here. This is, I know it was kind of I'm gonna say impromptu, but we wanted to do this pretty quick. And as I was talking with Joy last week, we thought it would be good to do a webinar. And so if you are attending here, go ahead in the chat. Just let me know where you're at, where you're coming in from. Just want to make sure that the chat is actually working. And all right, cool. All right. Thank you, Virginia. And my friends, if you like, we're going to have Q&A at the end. Joy's an amazing resource in the industry. And so we're going to have Q&A at the end. So if you have questions, just go ahead and hold those off to the end because I'm not going to like stop Joy mid-sentence while she's going through some of these things. And we want to keep it, again, we don't want to take a whole hour. I just put simply an hour block. So we're going to go through the important bullet points and then have Q&A. And so that way we have enough time for that. But it's a lot of stuff to cover. And obviously, as you all know, it's just there's a lot of headlines, a lot of Facebook posts, and no one and as I posted, a lot of you saw my post. I've talked to a lot of smart people, a lot of great people. No one knows what's going on, and so that's why I reached out to Joy and had that conversation because I know Joy has always been a wealth of knowledge for me when it comes to the credit side, and I learned things. I've been in the industry for a long time. I learned things that I didn't even know was like possible. So excited to have Joy here. So Joy, welcome. Thank you for taking time out because I know you got a flight coming up and everything else. And I know you're going to be on a world tour. Jeez, I got flipped up there over these next week and a half with events. So thank you for joining us.
Thank you for having me. Yeah, I ended up actually changing my flight because I'm going to the MBA. I'm going to 2 conferences back to back, and then I'll be at AIM-Fuse. So thank you for having me.
Oh no, absolutely. Yeah, you got NAM, MBA, and yeah, so you're a glutton for punishment over this next week and a half. So if you guys see Joy, make sure you buy her a drink, make sure you give her a hug, make sure because she's gonna need a hug. She's gonna need a hug and she's gonna need a drink. All right. So here is today's agenda. We're gonna go over the credit wars. This is something that Joy is kind of a phrase that she has coined, and she's going to go through that. We're going to talk about the FICO updates. Again, everyone's asking, like, what does that mean by FICO? So Joy's going to take us through that. And then we're going to get into that Vantage 4.0 and what does that really mean? The reality check for all of us. What is that going to do? How's it going to help? How is that integrated into the systems? Where are they at with it? I see all the headlines about it making it free. So Joy's going to get into that. We're going to get into what everyone posts about, and that is the explosion of credit report costs over these last year and a half or 2 years, even with where it used to be and where it's at now. Get an idea of how the data flows. A lot of people just like, hey, I just press the credit report button and I get my credit report. There's a lot of moving parts behind the scene. It also plays into the cost. And so we have just a very non-complex diagram to show you on that. And then Joy's going to talk about the critical role of the CRA. Right. And exactly what she's developed in her company. And so we're excited to get going. So the credit wars are here, and we're going to get the real story about the credit chaos. So Joy, I'm going to hand this over to you. What's the reality behind the headlines here? Like, what are brokers and obviously ultimately consumers up against with everything that's happening right now?
Yeah. So thanks. Wow. The war between the scores is what we got FICO, who is almost 75 years old. And then we have the VantageScore, which is owned by all 3 major credit bureaus, TransUnion, Experian, and Equifax. So what they've done in the last 20 years the bureaus have decided to come up with a scoring model that competes with the FICO score. So what that has done is that's going to create a competitive edge on what bureaus are going to be accepted, which ones aren't. Up until this point, it was back in the 90s where Fannie and Freddie, 1995 to be exact for those data people, is when Fannie and then the next Freddie Mac adopted the FICO credit scores for tri-merge purposes. And then what's happened over the course of the last 20 years is the landscape has changed. Our consumers' paying habits have changed. Our job situations have changed. Demographics have changed. So much of the landscape has changed. it's causing a lot of confusions and what ifs and what's going to happen to the pricing, the workflow uncertainty. I do have confirmation from Fannie and Freddie that they have been testing the Vantage 4.0, and they are further down the road on implementing that than they are the FICO 10T. So I look forward to seeing some of the pilots come out on that. I'm thinking we're going to actually see something midterm in 2026 on that. And that's going to help us better understand where we go with the Vantage score. So here's the other flip side. Why does Vantage score differ from the FICO? Because they're using a different scoring model, and what produces the score versus the FICO is it's different, and it's different enough to where it impacts at least 40 million of our consumers. Because we all know, Jason, how many consumers out there during the last crash in 08, 09, where they saw their parents and people went to a cash buying scenario, right?
Yep.
Because
Mm-hmm.
credit has been deemed as a bad thing where it's actually a necessity that we have to have.
Yeah. Yeah, absolutely. And so, with that, I wanted to get into like what took the headlines over these last couple of weeks, and that is the FICO announcement, right? And again, it came out, they're all excited about it. However, like I said, nobody can give me like, what does this actually mean? And I know you and I have been talking about it. So and instead of, cause like at the end of the day, it's what's known and what's unknown. And so ultimately, everyone was like raising their hands. Okay, well, what does this mean if FICO is going to bypass everything and just go direct? So what does that even mean? And so and as loan officers, like why does this matter to me? And what do I need to be prepared for?
So what it means is we are going to, as the CRAs, a reseller for the three major credit bureaus, and we'll talk about that later down the line, how
Mm-hmm.
that flows down.
Yep.
It's going to be a shift in the pricing where historically we have had some pricing wars regarding the FICO scores versus the Vantage scores. But here's the problem. Vantage is not, we're not using it for DU and LP purposes yet. So therefore, FICO is going to increase the pricing, the wholesale cost to the bureaus. And what's going to happen after they increase it to the bureaus, it's going to roll down to the rest of us. And eventually it boils down to the consumer's going to pay, is going to pay for it.
And so when they say that they're going to go, so like when they say like when they with their announcement saying like, hey, we're going to go direct, what does it like? I don't like. So does that just mean that like, hey, we're going to try to do it our way so that we could increase the prices to what the bureaus are doing? Is that what you're?
So there's speculation of that, right? So
Yeah.
there's so many lenders out there. I can see where the really, really big banks, without naming them,
Mm-hmm.
might have an internal negotiation with FICO. But at the end of the day, FICO doesn't have the technology to merge that technology. So they're going to have to rely on us as the CRAs to be able to merge not just the data, but the scoring algorithm that we're going to be returning back to the end user. So my take on that is no different than it's ever been, is FICO's still going to have to use us as a conduit for delivering a credit report with scores that we can use for DU and LP for
Gotcha.
loan decisions, basically.
Yeah.
But I really didn't follow what FICO was trying to say, that they were going to be able to go direct, because they can't go direct through the bureaus. They would have to go direct to us. But
Mm-hmm.
then we would have to create an agreement with our end users, basically stating you're going to pay per user, or per loan, or you're going to do a back end bundle. And then that's going to create a compliance nightmare for you guys as the end users. Because then you're going to, well, I shouldn't say it like that, but it's going to create more time and
More
more
complexity.
Oh
Yeah.
God, yes.
Yeah. And so I think it's just one of those things to where FICO's like, hey, we see like what everyone's doing. And so we're going to just announce this. We have no idea of like how it's going to work, but we're just going to announce it. Because that's generally what everyone's telling me are you reading the same?
Yeah, there's no clear picture. it's still changing. Like last night when Experian comes out with their announcement that they're going to offer the Vantage 4.0 indefinitely. Well, what does that mean? Because eventually the aspirations of the enterprises are to migrate from just a FICO to a Vantage score.
Yeah. Yeah.
So yeah, we don't know. It's just changing every day. But
Yeah.
as we migrate towards 2026, we definitely should see some changes. I really truly believe that in 2026, we'll be able to underwrite and process Vantage 4.0. It's coming. It's just when.
Yeah, and we have a little diagram that we'll show you that will kind of explain that, but because there was something I didn't really ever know either, so that's why I wanted to have this diagram, but also understanding that as of right now, FICO plays into when you're talking about loan decisioning, you're talking about DULP, you're talking about the pricing engines, and you're talking about mortgage insurance. Is that correct?
Absolutely, 100%.
Yeah.
And behind the scenes right now, they're running tests. They're building out they're mapping it out, is what you would
Hmm.
say in the data world, right?
Yeah.
So we can use it. Yep.
And it's safe to say if I'm an originator, look, I just want to just kind of keep my eye on this whole FICO stuff, but ultimately, like I just need to be head down doing what I do because it's not really affecting me.
Right now, it doesn't impact you.
Yep.
I don't see it until 2026
Yep.
because of the build out, not just with the DU and LP,
Hmm.
it's the pricing engine, it's the MI, it's the LOSs.
Yep.
We got to be able to deliver the different scoring models. And what I see is, and we've already talking about it, is having a drop down somewhere because of lenders accepting
Yep.
it at ABC. This lender's going to accept it, this lender's not. So the LO is going to have the ability to make that choice. So that falls back on the LOS,
Yep.
not on DU and LP. So there's a
Yep.
lot of moving parts. We're just not there.
Yeah, exactly. And this is what you were kind of walking me through last night. And my friends, I kind of consider myself a smart person, but even me, like I couldn't keep up with all the things Joy was throwing at me. And God bless her for being able to keep, her finger on the pulse of all of this stuff. Cause it's just to me, and again, it's like anything else in our industry. It's like, hey, ready, what is it? Ready, fire, aim, right? That's generally what everything seems to be. And that takes us to the VantageScore. You mentioned like, hey, we're just indefinitely, it's going to be like the free headlines. It's approved. Doesn't mean that, just similar to the FICO 10T doesn't, but it just because it's approved doesn't mean we're using it or doing anything. There's rollout and integrations, and then the free in practice. And what does that mean? And is that, so what's the reality on Vantage? And I know we talked a little about it already, kind of just as we were talking about FICO, but is this the same? Like we're looking at that same integration timeline, 2026, and then as far as like the cost consideration, that's kind of a movable target. We don't know what that's going to look like.
We don't, but you can count on the cost going up until and I believe, to my best of my ability, what I'm seeing is I do see a cost going up, and it's because of the war. I do see VantageScore offering a free alternative, but unfortunately, until we can use the Vantage scores inside of DU and LP, it's only for data collecting.
Yeah.
It stinks. I don't
Yeah.
like it.
Yeah, and this is why, like, so we like when I keep mentioning this chart because I think it from a visual, a lot of you may be like I'm trying to understand, but from visually you understand it. But like I think a lot of us just think it's just kind of like a one-to-one communication, and there's not. Like it's the data and how it goes, and then understanding that Vantage and FICO are algorithms, right? And
Right.
all of that data needs to go, and you'll see that here in a second. But ultimately, like Vantage 4.0, again, just another thing like with the FICO announcement, something to keep your eye on as an originator. Is it going to help you right now? No, it is not. But you need to understand that, but it's also something that you just want, just like with any professional in any industry. It's like this is going to play a major part at some point. And then going to what Joy was talking about, what lenders are going to accept this, what lenders are not going to do this, what investors on the back end. And for a lot of people, because I obviously from being a former owner of a mortgage or co-owner of a mortgage company, understanding the back end of secondary market, secondary marketing, capital markets, all of that stuff, and understanding like selling loans to investors, hedging, and all of those things, everything there's so many different variables. So it's not just as simple as much as we would like to say, this is going to happen and this is what we think. We don't, until we get, just like think about TRID. For those of you that have been in the business long enough, when TRID was enacted, like guys, like that wasn't a switch. That was like one is I think we had two like rollouts where like, oh, we're going to do it. No, we're not going to do it. We're going to do it. Now it's going to roll, it's rolled down, 6 more months. And then it was like a 6 to 12 month rollout of getting it in. And TRID ultimately, yes, it was complex, but like we're talking about like the backbone of how we approve loans here with credit reports. So like this is not a simple feat to take on. So we can only imagine that there's just going to be more chaos in it. And that's why it's important to have a good partner and at least a good brain to talk to, like Joy, because look, you guys are originators. You guys got to do loans, right? So you can't you can't just like be in every meeting or watch every webinar when it comes to these things. And so that's why having the right partner is super important.
And I appreciate you saying that, because this is going to be very similar to TRID, because we need these scoring algorithms to be competitive. It
Yep.
creates fairness, innovation, and it creates opportunity. There's millions, over 40 million consumers that cannot be underwritten under the current circumstances with the FICO today.
Yep.
That's a
Yep.
lot. And that's in
Yeah.
our buying power. That's the ages of 29 to 49. That's a
Yep.
lot of consumers. And so that's something that we, as a provider in this industry, we've actually created a solution. 40 million consumers
Yeah.
from the age
Yeah.
of 29 to
Yeah.
49. It's a lot.
Yeah. Yeah. So think about that and Joy mentioned that in the very beginning, is that like, look, we're just like anything, we're working off models that are just not built for the modern consumer, the modern economy, and things of that nature, because just things are different, right? And so we have to evolve, and this is just a part of that. So what everyone really wants to know is like, why the hell are my credit reports so expensive now? Like, what's happening? And so as Joy was like walking me through it, right, and understanding there's a lot of different costs and things that happen, and then what drives the increases. And you would think, right, because like if we talk to any economist, competition decreases prices. Not necessarily, right? Because we're seeing it front and center that it doesn't. There has been, and that's not a typo, right? When Joy was telling me this, I'm like, what? I'm like, really? Like that? So as Joy was walking me through it, yes, since 2019, when you look at the costs, right, it has been a 3,200% increase on what it costs to run credit, right? To, from the provider to the CRAs to like all of that stuff. Why? And then you have three competing scoring models, and that's the FICO Classic, FICO 10T, the VantageScore, all vying for the adoption. Again, going back to what we talked about in regards to the credit wars, right? And then looking at the integration points that are effective, right? Like there's so many different connections. And guys, like I didn't want to like, because otherwise this thing would have been like 2 hours long just going through all the different connections. So that's why we like really like just summed it up. But like all the different pieces that connect when it comes to the points of data, when it comes to that, right? So again, you got model competition, you got infrastructure complexity, and then you got the regulatory requirements, right? All of these different things, all of these little back end things that you have no visibility in, and honestly, you shouldn't like have to like take pieces of your brain to focus on like how all of this stuff works, because ultimately you just want it to work, and you want it to work at a reasonable price. But that is exactly why the costs have gone up, because it's not just like, hey, it's an increase to you, it's an increase to everybody downstream, right? It's like one of those like, what rolls downhill, this is this is what it is, right?
Yeah.
Did you have anything you want to add to this piece, Joy?
You actually, so you covered that. So I
Okay.
saw Karen's pop up on the question. So yeah, so Vantage has been around, it was, started 20 years ago, but the Vantage 4.0 has been in the marketplace for about 4 years under different pilot programs. And there are lenders, in fact, the FHLB out of the Chicago market has started accepting the Vantage 4.0. But the prices, the cost, the hard costs have significantly increased. And as we build out more integrations, so the cost of the integrations, there's programmers involved. So there's cost involved to plug and play with the pricing engines, with all the systems that we work with today, and now servicing. So there's a big impact on this. We've heard about it really, really strong for the last 4 years, but I actually see something in the horizon next year in 2026. And it's because of the ability to buy a house. There's some big news out there with the number of consumers, the projections. If you guys didn't watch the projections that Fannie and Freddie just released this morning, they were talking about, they lowered the number of amount of loans that were actually going to be originated in 2025. I think that's going to be a driving force for this big push for change.
Yep, absolutely. And
Okay.
guys, it's also important to note, like, so when you're in Q&A, and I just want to like preface this because as Joy and I were talking, just understand, just like with me in certain things, like there's certain information that Joy is not allowed to just give out, right? Like there's certain things in her, in her agreements with, with the boroughs and everything else as a CRA, she just can't say like, here's everything that they talk about. Like, so just understand that when she's answering questions, she's giving you everything she can. And if it sounds like she's like, oh, well, it sounds like there's something else. There probably is something else, but she just can't talk about it. So just know that, guys. And it's just like with me, whenever I have, when I talk about a technology or I talk about a planner or even because I still have NDAs from lenders and stuff that I've worked with 5 years ago, 6 years ago, that I can't talk about certain things that are behind closed doors. And that's why, as an originator, and this is just a little sideways, because I want everyone to understand, like all you see from an and look, if I was just an originator or just a marketer and I didn't have visibility into the whole like inner workings, it's kind of like how the sausage is made sort of thing, right? Like I would have no idea like any of this stuff is happening, right? But there's just so much stuff, so much crap that happens in the back end that like, unfortunately, and that's why we have so much chaos whenever we try to do anything. There is no standardization to a certain extent, right? There's some things, but even then it's like, it's almost just like, how do we view it and how are we going to look at it? Right. So just guys, I just want to lay that out there so you understand that like when you see something, I know to us, you'd be like, oh, well, they should just be able to do that. Logically, yeah, that makes sense for the information that you have, but just know that there's so much stuff going on behind the scenes that play into this. I was blown away, by the way. I was blown away.
And that goes to the point of the workflow efficiency. There's no two markets that are exactly the same, and who our community is, who we communicate with, vary across every single loan officer out there, from
Yeah.
lender to bank to credit union. They all vary. They're no
Yeah.
two alike.
Yeah, absolutely. So, of course, that doesn't add any extra layer of complexity, does it? All
And
right.
this is
So,
why that's important.
all right. So again, guys, look, I could have went as an engineer, like that's I'm an engineer by trade. I could have went stupid on this thing, but I wanted to really break it down and play English. And so I said, Joy, you got to give me something that is just like easy so that you all can see it and understand like how things go, right? So, Joy, do you want to kind of explain what this flow like? Because these are things that I didn't really understand either. Again, I kind of had some sort of like idea, but you kind of broke it down as far as like how all of this works and actually how a score is generated.
Thanks. So yeah, I'll explain it. So as you can tell, Experian, TransUnion, and Equifax, those are your data houses where the creditors report to. And
Mhm.
there's where your mistakes happen is the creditors report to the three major credit bureaus. Then you have FICO over here, you have VantageScore over here, and the host. Now I'm going to give you a couple of examples on host. Credit Karma. We all know who Credit Karma. They just use a Vantage Score 3.0, where you have so many. Good God, like you said earlier, we could start naming them all, but
Yeah.
you have different hosts and different
Yeah.
platforms that create that end user a credit file, which is also known as an in file, but it's a credit report
Mhm.
goes back to your LOS, and then but what he didn't draw you, there is intricacies of it. So they
Yeah.
pull in the data, they pull in the algorithm, they pull in other information, um, and then it creates the in file. It's more than one source. So we pull in the fraud detection, the the other information. It could be depending on how you have your in file set up. But there's
Mhm.
more than one piece of information that's brought in, and what we do is we merge that technology into a file that you can use with DU and LP, and then Gus and the other engines that you use. What's important to understand is we don't report the mistakes. The mistakes they start at the top. They actually
Yeah.
start at the creditor level. And it is our job as a CRA to assist you and the consumer. That's a big one, Fraser. If I can make that big
Yep.
announcement, they're going
Yep.
to start enforcing us as CRAs to help consumers dispute errors on their credit reports. And what that looks like, I can't tell you today, but I can tell you that we have actually started a whole team of credit experts, the credit success team, where we can help guide the consumers on disputing errors on their credit reports because there's so many of them.
Yeah.
I
And
could go
so,
on and on.
oh yeah, no, I know you can. And so, and my friends, like the way that I read and Joy, tell me if I'm right. So basically what you have is you have the data, all the consumer reporting data in the three bureaus, and then all of that goes into the host platform, whatever that happens to be. Then you have the FICO and the VantageScore algorithms that integrate into that host, right? And then as a CRA, you put all that data together, which then delivers the credit report with the scores, the three scores to the LOS. Am I saying that
Yeah, you
correctly?
said that right. So yeah,
Okay.
we
Yep.
basically we combine all the data into a readable report and a
Yep.
usable report. Yeah,
Yep.
that's what we
Yep.
do.
So guys, just so you understand, right? It's not like I press a button and then I get a score. Like this is what's all happening in the background, right? So like hey, give your LOS a little grace if it's taken a second to get to get that report to you. Just know that there's a lot of stuff happening. So obviously you're a CRA, right? And so I want you to discuss like the critical role of, because I see this in Facebook groups all the time about like, hey, who's your credit provider, Advantage Credit, or this or that, or this credit CRA, this CRA, who's the best, who does this, right? So I wanted you to discuss kind of like the critical role that a CRA has in this ecosystem.
Thanks, Jason. You put me on the spot there. So the quality control
Yeah.
is a
Yeah.
huge one. I just brought it up is the ability for consumers to actually get something that is erroneous on their credit report and get it disputed the right way is
Mm-hmm.
is is exciting news for us as CRAs
Yep.
to be able to provide that service for them. And that's where the quality control is the inconsistencies,
Mm-hmm.
fraud indicators. That's one of the data pieces that are pulled in and that we merge together.
Yep.
One of the examples recently, Fraser and team, is that you had a consumer out there buying houses in different marketplaces, and they were using the same credit report with the vendor to buy houses and claim that they were their primary residence. So that's part of the quality control and ecosystem that we have. The compliance management, making sure when somebody makes a complaint that we follow up with it. I didn't give them permission to pull my credit. Yes, you did. Here's your smart pay link. Here's your signature. Um, there's, do you work from home? Are you sharing an office?
Yep.
Making sure that you're not participating in credit repair and then charging the consumer. There's just
Yep.
so much red tape that we have to go through. The big one too is the technical support. Have
Yep.
you guys seen the drop downs in these LOSs? There's 6 Advantage credits. There's one credit information, credit info. But there's every single credit vendor in the world and then other, service providers, and they still have not updated them. And I find it perplexing why they can't, shorten that list, because Universal Credit is no longer part of us. They're part of Zactus, right? And
Yep.
Credit Plus, same thing. They're part of Zactus, and it's still on the drop down. Integration, that's where the integration maintenance comes from.
Yep.
We have to keep our connections current and our pricing engines and bureau system modifications. There's a lot of technical stuff that we do in the background. And that's why it's important for us to be able to hop on a Zoom, hop on a Google Meet, and walk a loan officer through DU or LP or even Gus. And so
Mm-hmm.
that's really important. And we are not all equally created equally. I thank you for sharing that because
Yep.
I don't think they know what we go through on the back end.
Yeah, no, absolutely. I know. Like I said, that you opened my eyes to a lot of different things. And so when I get into talking about credit strategies, and I talked a little bit about this is that, with what you're building with your company, because a lot of people, again, this goes back to the cost, right? And I have a couple members of my coaching group that are customers of you, and they talked, very glowingly about your service. And then I had mentioned, I was like, oh yeah, well, I was just talking to Joy about that, and we're talking about, kind of like your strategies on running credit. Did you have that? Did you want to pull up that?
I do. I have it right here.
Okay.
How do I
And that
share
way,
my screen?
so I'll stop, and then you should have a little button on the bottom that says share. And
Okay.
there you go. You can, and you could share your screen. So again, just another visual so that you guys could kind of see exactly the different strategies that you could use, as opposed to just running a hard pull straight off the, jump street. So you want to
Right.
walk them
So
through kind of what this is?
yeah, if you have questions, Jason, or if you think of something that we can talk about. So the hybrid credit report is very important in today's market because of the trigger leads. By the way, I don't sell them. However, with the new trigger build, there are some, that's a whole different podcast, Jason. But the soft pull doesn't cause triggers and neither does the hybrid, but we all know from experience the hard pull has really caused some industry shakeups, right? The firm offer
Mm-hmm.
of credit, this is going to be important next year.
Mm-hmm.
Um, the visual to lenders being able to read the credit report and run it through LP and DU.
Mm-hmm.
It does not have an impact on the scores. It is underwritable. That is is that even a word?
It is
Unwritable.
today. It is
It is
today.
now. I made it up.
You
What's
made it
gonna
up. There you go.
exactly? I made up is it loanable? Loanability, right? Loanability. I'm gonna come up
Loanability.
with some words. Why that's
Okay.
why I invented the hybrid, right?
Yeah. Yep.
Um, and rescorable. So our soft pulls are not rescorable. Okay.
Yep.
Written consent is a big one moving forward into a new marketplace where we are seeing more EARLs, more streamlines. It's important to have written consent, guys.
Mm-hmm.
Okay. Very important. They're going to really, really tune into that one. They've warned us.
Yep.
So again, the hybrid, you don't have to have, you can have verbal. Okay. Shows as an inquiry. This is where the secret lies in the secret sauce. So as we migrate to a different environment, that inquiry does not show up on the hybrid. And that's why it's really important. So servicers who are operating with UDNs, the undisclosed debt monitoring,
Mm-hmm.
anybody that had a relationship, a servicer or a lender, ever had a relationship with Jason now knows that he pulled his credit at ABC Mortgage, even with the soft pull, and they're going to come behind you and they're going to offer you something stupid cheap to where
Yep.
your relationship has to be right on with that consumer. The UDN, that's why it flows into the UDN detectable, is because the hybrids are not UDN detectable. Any questions on that one?
Well, we'll get to I'm sure there will be, but I think one of the things about that is the fact that doing that, the hybrid cost is at a fraction of what it is to do a soft pull or a hard pull, and you also have a lot of benefits, right? And so I'll let you get into that at the end when we ask like what the cost is, but generally, guys, you'll see what I'm talking about here in a second.
Yeah.
But as we wrap it up, right, is that guys, look, there's a reason why I work with Joy, because she's other than just being an amazing human being and very funny, she knows her stuff. I like working with operators, people that are passionate about what they do. And so what she has built when I talked to Joy originally was, look, she wants to be your partner, right? Plain English pricing, no, customized to your reality. And that was one of the things, is that, whereas with other CRAs where it's like everything to everybody, Joy actually offers a customized. And like I said, I have members of my coaching community that work directly with Joy for that. Is because they customize from market to market, right? So instead of making everyone do the same stuff, her plans are customized to your market and to the type of clientele that you serve. Streamlined setup, and then actual real support. right? And so this is what was important with Joy when she built her company, and so I just wanted to throw that out and just give Joy a little love on this last slide. So if you wanted to connect with her, hey guys, look, I'm sending out the recording, I'm sending out all the information, the deck, and also you guys have this, and you'll have her email and stuff if you want to talk to her and just have more questions, or you want to get an idea of like what her services are like. But Joy, when we were talking about the hybrid, and guys, you can start throwing questions in the chat if you have, is that, and I'll throw the website in here. It's mycreditinfo.com. And look, we already Carrie again, one of my members there. She works with it. So mycreditinfo.com. But when we talk about the hybrid, so I know you have a score hybrid and a no score hybrid. So what are the costs on those?
So we're going to roll out the $5 credit report again. I had a meeting with another broker, one of my other fans. I don't know if he's here or not, but we're going to try to roll back the pricing, moving forward into the next environment to where it fits your needs, the end user. And at the bottom line is that we're giving up so much money to credit reports, but at the same time, creating a win-win situation by rolling back a $5 credit report. Because Jason, we don't know if they're in the market for a refi or a cash out refi, or whether it's a streamline or cash out refi is where I'm going with that, until we actually look at their credit report, right?
Yep.
So do you need to run that through DU and LP? You don't know. And
Yep.
then do you need scores or do you not need scores? So we're going to roll back the pricing and try to give you guys a breath of fresh air for 2026. I'm excited.
Yep. So that's and the $5 is the no score option, correct?
So that's going to be the hybrid. It's going to be, I got to be careful who I say this to, but one of the bureaus is we're partnering up with the hybrid credit report for the no score.
Gotcha.
Hybrid. Yeah.
And then what about one? And guys, look, because this is a strategy. Because I've done a couple webinars on the strategy of having consumers pay for the credit report. Because again, having a couple people audit there and realize like, man, I've paid like $12,000 and basically credit reports that they don't get back. Right now, again, I know everyone's model's different. Everyone's like, well, I do a lot of upfront work, so before I get there and this or that. But ultimately, what we're talking about is not having to break the bank on getting you in a position to understand, like, what are you looking at? Are you looking at a real deal? Are you looking at challenges, things of that nature, things that you're like, look, I'm fine with charging them and having them, pay it back at close or whatever your strategy happens to be. But ultimately it's like, look, I don't want them, because this is just tradition. And it's not everyone. People have some people in my group have always charged for credit reports. So they have never paid for them. Some have only paid for them and they still only pay for them because they view it as a cost of doing business. No judgment. Again, there's no right or wrong. It's like everyone decides how they want to roll their business. But ultimately, if you could like, hey, if I had a very inexpensive option, just so I know what I'm looking at, I don't have to charge a borrower. I don't have to add any points of friction or any extra obstacles in front of the way until I know what I'm looking at. And then I can make the decision on whether I'm going to pay for the hard or I'm going to, have them pay.
So, right. And what it'll do, it'll set its parameters to whether or not you're going to want to move forward, because your book of business, your parameters. Did they have a 30-day late on a current mortgage in the last 6 months, 9 months, 12 months, whatever it may be. But a lot of you are familiar with the old waterfalls and that technology, and being able to upgrade this to a full report that you can use for underwritable purposes and being able to recoup that $5, it's huge. So we're going to roll back the price.
Yeah. And then think about the hybrid as one is you don't get it. You don't get a trigger on it. Cause guys, look, as much as we want to say, hey, great, it's awesome of all the work that we got to get to where it is, there's still some things that need to be done, and it doesn't go into effect for another 4 months or so. And then when that happens, there's still the implementation. And that's what I always say is like, my friends, if you've been as old as I am and you've seen a lot of different things and rules happen, like there's always like, hey, this is what we thought was going to happen. And then the implementation wasn't what we all thought it was. And maybe it is, maybe it isn't. The point is that it's still going to take time for that to happen. And as we've talked about, like when our industry rolls anything out new, it's going to take time to layer. So it's great to have an ability to do this where you don't have to worry about getting credit triggers. It is something that you can underwrite to. It is something that that is going to be more inexpensive. All of that is important. So we got a lot of questions here, Joy. So let's go right
Yeah.
into one is like so the first question is, when the new credit models officially become usable for credit underwriting, will we be able to choose which model reports we want to utilize and roll with?
Yes,
Okay.
that's a great question. Yes.
Yep. Yep. And then one is, how long will the current tri-merge reports be usable?
So they actually rolled back on going to a dual merge. Is that helping you answer that question? Are you wondering whether or not we're going to go from a tri-merge to a dual merge? Is that the question you're asking? Because if so, the dual merge has been put on the back burner because of all the research, because not all creditors report to all three bureaus. And it's the cost of reporting. And then on top of it is because of the cost of reporting to the three major credit bureaus, we're seeing more and more creditors not report every 30 days. It might be on a different cycle. So here we go. More change.
So yeah, so Mike was wondering, like, after the new model hits, that where the will the current tri merge still be usable?
Yes, from what I understand, they're going to continue with the classic FICO.
Gotcha. And then different, I think we kind of covered a little bit about this, but if like that, as far as pros and cons between the new models compared with the existing model, to me, and I think it goes right into his second part of that question, which is like factors that impact overall credit score, non-traditional trade lines, like Experian Boost, missed payment, a Netflix payment, that type of overdraft charge. Like as far as like the new models, where like pros and cons of that?
So I think the pros of the new scoring models is going to impact 40 million new consumers for the
Mhm.
housing market, which is a
Yep.
pro.
Yep.
Cons are is we are actually ourselves, we are actually building a non-traditional credit model to where we can actually add non-traditional now to the credit report to where it impacts the FICO Classic today.
Yep.
So you can close on them. Whereas in the future, once the Vantage 4.0 comes out, we're having to we're having to combat the if they miss a payment to any of those non-traditionals, we can't, there's no way of deleting it. Once it's reported, Fraser. That's the
Mhm.
con, is I don't think consumers understand the implications that it could have on their credit report. And so
Mhm.
their payment history is going to become very important.
Gotcha. Now, would it be services that we like cable and Netflix? Is that something that you see being a part of that as well?
100%
Yeah.
non-traditional cell phones, cable, insurance, anything
Hmm.
that you can provide a payment history without it being a like child support. If you're
Yep.
paying child support through your checking account, it's, and even if it's court ordered, as long as it's not
Hmm.
being garnished, you're good.
Yeah. And then you talked about you building a model. And so again, I want to kind of relay this back to like the importance of CR or more of what you're doing is that for like a whatever, and some originators may not understand this, but like, so like, for example, if I'm an originator and I want to do a rapid rescore, they don't necessarily need to do a rapid rescore, right? Like they could just talk to you and then you guys can do your magic, right?
We have a system in place that we are working on. Thanks, Jason. You put me on the spot.
Sorry.
It's okay. You guys listen. We all know that we can't charge the consumer for a rapid rescore, which is absolutely insane. Because at the end of the day, it doesn't just impact us, it impacts them for
Hmm.
not even loanability, but even their score and their interest rate. It impacts so many parts of their loan. And the error isn't even on them, it's on the creditor side. But yet we all get punished for that, right? And
Hmm.
then so what we have is we have a solution that it makes the rapid rescores look simple. And the hybrid is the best solution for that. So, well, giving it away, we have a solution for that. Kind
Okay.
of actually two of them.
All right. Perfect. All right. So another question for Mike is, oh, the non-traditional. Is that something that what you just mentioned about the non-traditional, is that something you're building or is that something that's available now?
So we are building it and it is available now. We are, we're actually doing it. So
Mm-hmm.
I don't want to come out and say, oh, here we are with the
Yeah.
non-traditional. Well,
Yeah. Yeah.
like any technology, any
Yeah.
process,
Mm-hmm.
if you are willing to help build it with us, I would love to do it with you.
Mm-hmm.
And literally at free to a degree. It's free, but you have to buy the report. But on the non-traditional piece of it, that's part of the build out is offering something free back to our consumers.
Okay. And so if that, and then so that would, if, you know, if there are doing, if you are working with someone with that, then that will positively impact the current models, correct?
Yes, we've actually
Okay.
had a couple loans close with, can I throw a lender out there?
Sure. Why not?
Windsor.
All right. There we go. Shout out to Windsor.
Windsor, and we have two wins where they were reporting through the Oscar system and went to bat. And that's another thing we do. So we actually work with the lenders and went to bat with Windsor and said, this has a positive impact on their credit. This is not self-reporting the self-reporting like
Mm-hmm.
Boost. This is a bona fide replica of a creditor reporting through eOscar, and this
Mm-hmm.
is compliant. It's compliant ready. So,
Beautiful.
oh, Mike
Beautiful.
on it.
All right. I love it. All right. I don't see any, okay. Okay, yeah. So Mike, you have her contact information. You have the website. Go ahead and reach out. My friends, look, you know, the reason why this is important because ultimately is um, you get to help more people, right? And obviously, hey, you close more loans, right? You make more money. That's awesome too. But mostly is what Joy mentioned. And this is what I'll say to all of you, because this is behind the scenes stuff that you guys don't get visibility to, is my conversations with Joy. And that is like like when I talk with Joy, it isn't ever about like CRA, I get to do this, I get to do that. It was like, we get to help more people. That was like literally like the second thing she said to me was like, she's excited because we get to help more consumers, right? And she's like, and I also get to help my clients do more business, right? And it was one and two. And that's why it's so important. And I've been in the industry for a long time and worked with a lot of people, but this is why I like to do these webinars, because one is it gives you more visibility into things that you may not know, because if you're only like seeing what is posted in headlines on like a Housing Wire or MPA or stuff like that, obviously all of that is like pretty much pay to play type stuff. And again, that's just how media works. So I'm not like throwing shade at any of them. That's just how it is. But that's also what I want to do is like, I don't want to do that. Like, you know, there is no pay to play here. Is like when I see something that I think could help the community that will help you help more consumers and maybe decrease your costs at the same time, then I want to bring it to you. Right. And then you could have the conversation. If you decide it's great for you, cool. If you decide it's not, cool. Ultimately, I want you have as much information as possible, just like you want with consumers, so that you can make an informed decision and that you could run a better business. And that's why, you know, after my conversation with Joy, you know, Joy, I'm like, let's do a webinar on this. I know it's like last minute and whatever, and I know you got to catch a flight, but like, if we can, let's try to squeeze this in and do a webinar and see if we could help people. And yes, Ron, yes, you are able to do the hybrid now. So reach out to Joy. Like I said, I will send out the recording and all this stuff out there. I put in the website in there as well, but let me put in Joy's email address just as we're wrapping up here. Joy, thank you so much for
Oh, thank
changing your
you.
flight to do this. And thank you for educating us. Like I said, my friends, like you got the cliff notes, right? I got like the full onslaught of these last couple calls with her. But I think you guys get the idea. Ultimately, like she's telling you the information that you need to know, and she's not like, you know, again, like there's some things she can't talk about until it becomes, you know, public knowledge. But ultimately, like she's telling you as much as she can right now and what matters to you, what doesn't matter to you. But ultimately, you know, she's an open book. Like I said, if you're going to be going to whether it's NAM, MBA, or Fuse, obviously I will be at Fuse next week. other than giving her a hug, get her a drink, and have a conversation. She's passionate. She loves talking about this stuff, and you're going to learn a little bit, just like I have.
Yeah, and signing up, that's another thing, Jason.
Hmm.
And they will all tell you the same thing. Signing up with a credit vendor has been painful.
Yeah,
Oh no, it's got to be easy or I'm not doing it. If you
yeah.
know me, I'm gonna tell you. And where's that easy button? Because at the end of the day, it needs to be seamless. And so we're creating that path for you guys because at the end of the day, it's our communities that we impact and home
Yeah,
ownership is key. And then educating our consumers about credit and how it works and why it's important. So I want to be part of the solution. So
yeah, absolutely.
contact me.
Love it. All right, my friends. Well, that looks like the questions. Thank you so much for hanging out with us today. Joy, again, just travel safe, my friend. Thank you for taking time out of there and changing stuff. And thank you for educating us and giving that. Reach out to Joy if you guys have any questions and go further down the rabbit hole on this stuff, because I know there's a lot here. And I hope you all, again, thank you for taking time. Hope you guys have a great day. And hopefully I'll see some of you at Fuse next week.
See you later.
Joy, thank you.
Bye, guys.